main problems. So here, if the interest rate on short-term government bonds decline as a result of open market operations by the central bank must have. All right. So the first thing I would do is I'd look at the MS demand. Whenever I see something about the central bank open market operations, I'm going to think of this graph. Well, for interest rates to decline, the money supply has to increase. Okay. So there's three things that will increase the money supply: buying bonds, lowering the reserve requirement, or lowering the discount rate. So now I'm going to look at my multiple choice answers. Purchase government bonds is A, so A will be. Selling government bonds, that would suck money out of the system. That would raise interest rates, decrease the amount of currency. That would not help either. So there you go on that one. An open market field operation by a country's central bank to reduce the unemployment rate would be 2. All right. So here I'm thinking 2 graphs to decrease the unemployment rate. And again, I've seen the central bank. All right. So if you remember, real GDP, income, and employment are all that bottom axis. So I need something that's going to shift AD to the right. All right. Now, I'm going to remember if I increase money supply, interest rates decrease, investment increases. Investment will shift AD to the right. So again, here, I need something that's going to increase money supply. Sell bonds, no. Sell bonds, no. All the A, B, and C is sucking. That would increase the interest rates. I'm looking to decrease the interest. I buy bonds to decrease the no, I don't want to decrease aggregate demand, so D is gone. E, buy bonds to decrease the interest rate and to increase. So E is it, because if the Fed buys bonds, money supply increases, interest rates decrease, investment increases, and aggregate demand increases. Knowing the impact of interest rates on investment and aggregate demand is important. Okay. All right. If the reserve ratio is 10%, what is the max? All right. When I see maximum change in the money supply, I realize that I'm probably going to have to use the money multiplier. And now I have John's deposit. All right. So it's a deposit and it's the maximum change in the multiplier. So this is what I do. It's a $50,000 deposit. I know I have to keep 10% because that was the reserve ratio. And I have to keep that $5,000 in required reserves. If I take that 50,000, I minus 5,000, it allows me to have 45,000 in excess reserves. I then know, because they want the maximum change in the whole money supply, I need to use the multiplier. The money multiplier is 1 over the reserve requirement. 1 over 0.1 equals 10. 45,000 times 10 is 450,000. I'm going to go back, and the answer is D. Now, how about if they flip this and they said, John withdrew 50,000 in cash? I just put a minus sign next to the 450. Okay. I could figure it out the same way. So whenever you have a deposit and we're looking at the total maximum change in the money supply, you're going to take the required reserves out and you're going to times the excess times the multiplier. A bank has 200 million in demand deposits and 150 million in reserves. The reserve ratio is 20%. What is the maximum amount of loan? Okay, so this is loans for the bank. I know if it's just the loans for this bank, I'm not using the multiplier, okay? I'm using the multiplier for maximum for the system. Or so that being said, $200 million in demand deposits, 150 in reserves, 0.2. Demand deposits times reserve is how much I have to keep in reserves. So 200 million times 0.2 is 40 million must be kept in reserves. I have 150 in reserves. I only have to keep 40. So 110 could be loaned out. Okay, of that 150, I could loan out 110. I'll go back and there's the answer C, 110. So this bank could be loaned out 110. Now, if they ask for the maximum amount of loans that could be made in the whole system, I would then take 1 over 0.2 to find my multiplier as 5, right? And then I would take the 110 times 5, and it could be 550 million loaned out for the entire system. Assume that banks hold no excess reserves. A decrease in the required multiplier reserve ratio will cause the total reserves in banks, the money. All right, so there's going to be, if you change the reserve requirement, there is going to be no change in total reserves, because whatever was in required reserves is now going to go into excess reserves. So total reserves will stay the same. Now let's look what it would do to the money multiplier. 1 over the reserve requirement is 1 over the money is the money multiplier. So if we did 1 over 0.5, the multiplier would be 2. And then if I lower the reserves, the multiplier will be 5. So it would increase the money multiplier. Now, at 0.5, I have 50,000 in both required and excess reserves. If I lowered it to 0.2, I'd have 80,000 that I could lend out, and the multiplier would be 5. So the answer would be total reserves, no change. Money multiplier increases, and money supply is going to increase because the banks can lend out more money and the multiplier is higher. All right, when Stephanie took out a 1-year fixed loan, all right, so a 1-year fixed loan, if it's fixed, that means nominal interest is not changing. She expected to pay a real interest rate of 3%. At the end of the year, the real interest rate has fallen to 2. Which of the following could have caused a decrease in the real interest? All right, so I'm going to go with nominal equals real plus inflation. The fixed interest, like I said earlier, states nominal doesn't change. So let's just pick a number and say the fixed interest is 5. Then the real is 3. Inflation would be 2. Okay. Now, if you look at the problem, at the end of the year, the real interest rate had fallen to 2. So that means inflation has to go up to balance the equation, right? So now inflation would have been 3. All right. So let's look here. There was an increase in nominal can change, it's fixed. There was a decrease in the money supply. A decrease in the money supply would get interest rates up, investment down, AD left. Now that would make price levels fall. The actual inflation rate was great. D is the answer because inflation went up. All right, let me review that one more time just to make clear. I used the nominal equals real and inflation. Nominal is fixed. So it's 3. And then I just picked out a number, 5. The real is 3, so inflation would be 2. Then if real goes to 2, to balance it out, inflation has to increase. I go back, the actual inflation rate was greater than expected. Which of the following is a monetary policy aimed at increasing the equilibrium interest in the money market? All right. If it's the money market, I thought I had the graph. I want to get the interest rates out. I'm going to sell bonds. Money supply is going to shift left, and interest rates are going to go up. Okay, so which of the following is a monetary policy aimed at increasing the equilibrium interest rate in the money market? Selling bonds on the open market. It sucks money out of the money supply. MS shifts left, interest rates go up. Which of the following will occur in the money market when aggregate price levels increase. Okay. Now, on this whole price level thing, that's going to be, if you look at the money market, okay, here, you're going to shift the demand, because remember, demand is, do you need more or less money in your pocket? Well, if price levels go up, you need more money in your pocket. So the demand for money will increase, and nominal interest rates will increase, right? Look at the graph, nominal interest rates went up. So it's going to be C as in Caroline. Now, this one they gave to you a little straightforward. A lot of times what they'll do is say aggregate demand shifted right. Now, if aggregate demand shifts right, you know price levels are going up. And then what effect does that have, say, on nominal interest rates? Well, the effect on nominal interest rates when price levels go up is MD shifts to the right. So whenever you see price levels, realize people are going to need more money. That's the demand in the money market. And again, be alert for them giving you something that shifts AD to the right and then coming back and asking for nominal interest. All right. Suppose the Fed buys $400 billion worth of government securities from the public. If the required reserve ratio is 20%, the maximum increase in the money supply, boom, I'm thinking money multiplier. All right. Fed buys, that means there's going to be increase. If they sold to be, so I'm looking for an increase, I know I'm going to have to use my money multiplier. Now, the Fed and deposits, you have to get them right. Okay. There are some really hard problems. These ones, if you could just really focus on and make them sure, give me's. All right. So it's 400 billion, 0.2 is the reserve required, and the maximum change. All right. So the money multiplier is 1 over 0.2, which is 5, and it's 5 times 400, 2,000. Okay. Remember, when the Fed buys or sells, there's nothing to do with the reserve requirement. If it's maximum change, it's the multiplier times the 400. Now, how about if they asked, what is the initial change? That would only be 400 billion. Okay. Now, when the Fed puts 400 billion into the system, there is a change because that money was out of the system and now comes in to the money supply. Which of the following would most likely which of the following will most likely result in an increase in aggregate demand? An increase in interest rates. Lowers investment, AD left. A disruption in global oil policy, that's cost push inflation or stagflation, that's SRAS to the left. An open market purchase of bonds by the central bank, that would lower interest rates, increase investment, aggregate demand to the right. Okay, so C is the answer. Now, remember, anytime you're thinking aggregate demand to the right, think price levels are going up. All right, I hope this helped you, and I'll talk to you later.